Hello everyone. Let me begin with the month gone by, the month of June. To begin with the good news first, a couple of things which happened in the month of June. We saw a rate cut of 25 basis points on 2nd of June. Secondly, we also saw more than anticipated better monsoons, contrary to the street expectation of a below normal monsoon. Also, the not so good things for the month of June largely were the heightened volatility that we saw in the fixed income markets. So, on the day of the policy, yields which were hovering at about 7.65 levels actually inched up 25 to 30 basis points through the month, and approximately 20 to 25 basis points kind of volatility on either ways were experienced across the month of June. Now, what really triggered the reason? A couple of things. Firstly, the good news of the rate cut on 2nd of June was not really good news for the markets, largely because of the not so perceived dovish statement by the Reserve Banker, where the expectation was that the markets were led to believe that the central bank has gone on an extended or maybe a permanent sort of a pause on the rate easing front. So that obviously led to some dissatisfaction and a sell-off in the market. Secondly, the uncertainty brewing around the Greece front, which was due to make payment to the IMF, that again was a question mark. So we saw all-round volatility even in the global yields, anywhere in the range of 50 to 75 basis points. Nevertheless, the dust seems to have settled right now. Our take is that the Greece news is largely into the prices, and more specifically, Greece is a very insignificant portion of the entire Eurozone, less than 2%. So we do not perceive any direct impact on India as a country, as a region, both on the capital markets as also on the fixed income markets. What should the investors do right now? We believe that the yields heading towards the rightmost band, the 10-year benchmark, on the run benchmark yield is close to about 7.85%, and the old or the erstwhile 10-year benchmark is already trading above the 8% region. The rest of the yield curve on the sovereign side is anywhere in the band of 8.1 to 8.15. We believe that these are extremely, I would say, opportunistic buys to gain exposure on the duration front. To that extent, we remain constructive on the bond and the gilt story, and would recommend investors to stay put in duration funds or possibly increase allocations at the current levels. The reasons why we believe that the duration story will pan out is because we expect the Reserve Bank to ease rates probably by another 25 basis points before the end of financial year 2016, and probably for the remainder of calendar 2016 maybe another 50 basis points, but that would largely be contingent on the way inflation pans out. We do not expect monsoons to play significant havoc on the inflation at the current juncture, largely because of the past history of the current government being able to manage the food side supply if there were to be a below deficient or below normal monsoons. So with that, we believe that the outlook for interest rates continue to remain favorable. The shorter end of the yield curve is also reasonably well supported because of the fact that there is reasonably comfortable liquidity in the system. We expect this scenario to continue into the near future as well. The month of June also saw advance tax outflows, which did not dent the shorter end of the yield curve, vindicating our stance that the current yield curve remains attractive as also supportive. What are the strategies that investors could look at the current juncture? Well, as I said, the duration pack continues to remain attractive, especially in the light of the recent 25 basis sell-off. So one could look at allocations to Kotak Gilt and Kotak Bond kind of strategies. We reiterate, for those investors who do not like or would not want to withstand such kind of volatilities, the short-term space with a higher accrual like Kotak Income Opportunities and Kotak Medium Term do make imminent sense. To conclude, we want to reiterate that volatility is something which is an inherent part of every asset class one should not really shy away from it, but rather look to participate in the anticipation of making profits going forward. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.